You know, welcome. Um, Welcome to this call. It's the community call number 9, and we've crossed the transferability event. The summer token is live, and there are lots of things that are ongoing at the moment, and lots of proposals on the forum. And I think today's call will be about structure, how we design new products without breaking old ones, how we manage risk at scale, and how the summer token fits into this picture. I believe we've got Jordan, we've got Chris, and we've got several community contributors on the call, and I'm gonna invite you guys in specific moments. But I'll also keep things moving, of course, if anyone drops out or we're gonna be running short on time. To start it off, I would like to walk through very quickly through agenda. So we will be talking about DAO-managed votes, what they are not, why the separation from the curated votes matter here. We're going to be talking about risk caps and fleet level controls, how we manage risk as the protocol scales. We'll also talk about the summer token and the next steps here, sort of liquidity incentives and the governance alignment post the transferability event. And of course, we'll have an open discussion. So any questions that goes through, or if you have any questions on your mind, please either post them in the chat or then raise your hands and come in. All right. I think we should jump straight in, and let's hop on the first topic here, which is the DAO-managed votes. I'm going to frame the problem to begin with, and then I'll invite Chris to tell us more about the DAO-managed votes and the most recent proposal that we can see on the forum. It seems like this discussion is really about why the DAO-managed votes exist as a proposal at all. It's really not about replacing anything. It's not about undoing block Analytica's role at all, and it's not about pushing risk onto users without disclosure. I think this is really about separation of mandates. The DAO-managed votes, sometimes referred to as indexed or governance managed votes, are proposed as a separate product line with very clear characteristics. So these are going to be explicitly governance approved strategies, more risk seeking or more sort of market expressive, with a clear disclosure that outcomes may be more volatile. Parameters and arcs are not fully decided via the governance, not yet for the new upcoming arcs, but of course, as the concept, the DAO-managed votes will be decided in terms of parameters and arcs decided fully by the governance. I think the key point here is that risk is not hidden; it is chosen. By contrast, these votes, these indexed votes, they differ from block Analytica curated votes by sort of, if we are looking at the block Analytica curated votes, they are really safety first. They are conservative, and they are designed for predictability and capital sort of preservation. They're operated under a strict risk mandate by block Analytica, and that mandate is not always as flexible as some of the more riskier strategies that are present on the market. So the separation matters here because it removes the pressure on block Analytica to stretch essentially their framework, and it gives users a clean choice between profiles. And of course, it lets the governance express conviction without compromising conservative products. From a DAO perspective, I think it unlocks something really important here. It kind of says that we believe in this sector, in this yield, or in this timing, and really, again, without forcing that belief into votes that are designed for the opposite goal. At this point, I would like to pull Chris in. I also was reading through SIP 519 that is directly about enabling this framework. Could you walk us through what the SIP actually authorizes here, and maybe what's the current status of the proposal?
Yeah. So SIP 519, I should say, and I've just added it to the forum link as well. But just for any of those that haven't caught up on these DAO-managed vaults, and here's the thing. But yeah, as Jency said, SIP 519 is now just gone to vote. Although voting obviously opens tomorrow on that, and apologies from myself for that being a day later than normally planned on a Wednesday. But yeah, this effectively just gives direction for Block Analytica to make a start on the DAO-Managed vaults framework that they have proposed about a week ago, just prior to this call, actually last week, or I think it might have been a Wednesday before. But yeah, so they put a proposal up there for $25,000 basically, and then the 5% kind of fee of the management fee. So obviously what I've also proposed a couple of days ago is like kind of the initial tip streams and so on, of how these vaults can work. Proposed how the guardians can fit into these, and a slightly different role for guardians in these vaults than other vaults, where guardians will be able to basically set the risk caps of any market to 0. So they will not have any other risk parameter control. That will all be decided by the DAO, but the guardians will be able to actively remove a market, but not re-add it again. So they will be able to remove a market by setting the risk cap to 0, and then allow the DAO to make a decision if they want to increase that. What that gives us is otherwise the guardians in the current design would only have the power to pause a market, pause the entire vault. So if there's rumors of a market having problems or whatever, then the guardians can pause it, so no withdrawals and deposits can take place, but that doesn't actually help potentially protect any funds. So the proposal here is that guardians actually be able to have the power just to set risk caps to 0, and they almost become kind of like full-time guardians primarily for these vaults, but also obviously still of the risk managed vaults as well. And what we've proposed in here is a 15% of the fee going to them. So the proposed fees for the vaults remain the same as the other vaults. So 1% on stables and 30 basis points on volatile assets. So yeah, guardians taking 15%. The risk manager taking 5%, which is a 75% decrease. That's down from 20% on the risk managed vaults. And that 5% really goes towards, if the risk framework is approved in SIP 519, then that 5% will go effectively be a fee towards Block Analytica to kind of like maintain and make periodic updates to that risk framework as the kind of like industry and the space kind of changes in a way. And if you remember, the risk framework is typo 518, 519 for the on-chain vote. Oh, okay. I'll make that change. I think I may have accidentally made a typo somewhere in it somewhere. But yeah, the idea really here being that obviously like the high level thought is that we have potentially 3 categories for the DAO to be able to put any market into, if at all. And then what Block Analytica will do is create that framework to identify kind of where markets would sit in those 3 categories, if at all, again. So it creates a very kind of simple thing. So this proposal is simply just transfers 25,000 USD. Most of that is actually in ETH, because that's all we had left on the treasury right now. So I think it's like $17,000, assuming ETH is at $3,000 from mainnet, and then I think 7,000 ish from USDC on Sonic. But yeah, details are in the vote, so go have a look there. And yeah, Block Analytica have kindly agreed to kind of start working on the framework to try and hit our kind of timeline details. So they're actually going to make a start on this already. And obviously then if the vote starts to go the other way, then obviously they will stop. But assuming the vote goes the correct way, they have already made a start. And really the ultimate outcome here was the week of the 2nd. So this being kind of next week. So at some point during that week, we actually deploy the new vaults to base in Ethereum, probably USDC vault, ETH vault, on both, all without arcs, but just deploying the vaults. Obviously, the hope is then as well, and on the week of the 9th, that with those vaults kind of deployed, then we can have the guardians added, and the guardians can obviously perform some kind of checks in those vaults and so on as well. And then on the 16th, we actually go live with the DAO-Managed vault. So the week after, effectively the week of the 9th, is assuming that we have the risk framework completed by then, which is Block Analytica's goal for that. We can have the first arcs and markets effectively added to the vaults that have been deployed the week previously to have them already. And yeah, as well as the vaults being deployed next week, the idea is to have the initial arcs and markets proposed to the forum, obviously without risk parameters. So assuming that the risk framework is then here, the DAO kind of knows which, maybe like the first 5-6 markets on each vault it wants to add on there, so they're kind of like ready to go. So assuming then that from a kind of like engineering point of view, we can have all of those markets ready, they can be deployed. And then obviously that week of the 9th, governance can then just vote for the parameters to match the framework in there. So yeah, everything's kind of full steam ahead for that right now. And what that means is the week of the 16th of February, the DAO-Managed vaults can then go live and be open for deposits.
That's very exciting. I have a question here actually regarding the keepers. Are keepers going to be active the same way as they are under the risk curated vault by Block Analytica? Are they going to be sort of allowed to do the same rebalancing of the strategies in the DAO-Managed vaults?
It's proposed to use the same keepers, so the same keeper network, so they will do the same kind of analysis and so on as the actively risk managed ones. The kind of hope and expectation is that the keepers will also though perform kind of additional checks, and these can also be implemented again on the actively risk managed vaults as well if we want them to, but maybe it's a good kind of playground in a way for the DAO-Managed vaults. But they will ideally go and kind of check liquidity and make sure that because the DAO-Managed vaults idea is probably that there won't be much, the absolute caps may be hard to manage from a DAO point of view, like from a framework point of view. So that if you imagine the DAO-Managed vaults and so on would most likely just primarily probably have TVL as percentage caps on there, and then the keepers would handle the kind of like the theoretical max deployment caps in a way based on liquidity. So if we imagine that perhaps the risk framework states that like category 1 never wants to provide more than like 50% of the instant liquidity to a market at any one time. So if the instant liquidity on a market is 5 million, never have more than 2.5 million. So never have more than 50% of the instant liquidity on a market available at any one time. There's obviously edge cases with that because we have things like syrup from Maple Finance and so on that is always a withdrawal request and so on. But yeah, generally kind of the idea there is to keep us taking a more active role of deciding what the absolute maximum to deploy is based on the instant liquidity of a market at any one time. So if a market starts to basically have its utilization increase and the instant liquidity starts to drop away, the keeper should start to also remove liquidity to maintain that kind of target percentage in theory. So yeah, same keepers, same kind of like initial rebalancing techniques, but with some maybe slightly added kind of risk awareness stuff building into them.
Sounds good. Of course, I would like to open up the floor for anybody on the call. If you guys have any questions, please raise your hands. Otherwise, we can then continue on to the next topic. All right. Well, forum is open as always, and yeah, I'm looking forward to the outcome of this proposal. Thank you so much, Chris, for giving us a run through of what this proposal is about. I would say we can move on next to the risk caps and fleet-level controls. So basically, why these risk caps matter at scale. You know, as the lazy summer protocol grows, risk stops being just a vault level question. At the small scale, you can think of it in terms of is this vault safe? At the larger scale, you have to ask how much of the protocol is exposed to the same underlying failure mode here. When it comes to vault level versus fleet level caps, these vault level caps limit exposure inside a single vault. fleet level caps limit exposure across the protocol, even if assets sits in different vaults. Here, maybe I would like to bring up same here as you to since there's been a number of proposals and comments on the forum, and yeah, if you could maybe run us through what these sort of risk caps and the additional new arcs being proposed are about.
Yeah, sure. So it makes sense to talk about it in relation to the DAO-managed vaults and stuff like that. So fundamentally, you know, the lazy summer protocol is about automated access to really high quality yields, and the DAO-managed vaults, as Chris alluded to, do this in a very sort of programmatic way and more risk-seeking way. Which is really good. I personally like that as a user, so that's great for me. But you know, the key phrase of the let's say core vaults are that they are risk adjusted, meaning that they care about volatility, both to the upside and the downside. And that means that there has to be a very thoughtful and quantitative approach to risk management. And how that manifests in the lazy summer protocol is through the notion of these risk caps. You know, questions like how much capital can go into a certain yield source at any one time, or what is the max percentage of capital that can go into any one yield source as a percentage of the total capital in a specific vault. And since early November, as you know, read the stream finance thing and the balancer exploit and all of this stuff, the risk caps within lazy summer protocol have been extremely conservative. And what that means is that from a user perspective or a depositor perspective, you know, the balance of risk reward, or the trade-off between deploying in lazy summer and deploying, you know, just a vanilla yield source like Syrup USDC or you know, AVV3 even, or Sky SUSDS, it's a lot more. You have to sort of think about it a little bit more in terms of the yield that you're getting in lazy summer is maybe slightly above though that of, you know, Sky SUSDS or another benchmark yield like that, which has its benefits. Like, it's certainly, in my opinion, it is still beneficial to be deposited into the lazy summer protocol, because as things change, you'll get automatic exposure to, you know, the underlying yield sources that are you know, maybe more attractive. But the only way that can happen is if risk caps are raised, and risk caps have been set to 0 across quite a few arcs. Maybe it actually makes sense to share my screen just to show what I mean, to not be speaking in sort of hypotheticals in a way, or to be speaking in the abstract. So if I share my screen here, you can see that if we click on this USDC higher risk, I think it's the most egregious example, which is if you look at the yield sources here, the vast majority of them are set to 0, as you can see. And some of them are yielding fairly good yields, especially relative to, well, Sky rewards is quite high, that's great, but we're allocating 0 to them for some reason, when we could be allocating okay, interesting. Anyway, these are the arcs that, or the yield sources that users are getting access to today, which actually seems not bad, but it's time now, in my view, to open up the open up the door to other yield sources that are more competitive, let's say. And yeah, that to me is very important, so that users who are, especially with DAO-managed vaults, the contrast is going to be fairly stark, I think, in terms of one will be much higher yielding but higher risk. But we still want these vaults, these core vaults, to be, very competitive. We want them to be very good, and distributed across many more yield sources than just 1, 2, 5 today. So that's number one, is risk caps, and then number two is yield sources. So one thing that really piqued my interest was, or not just interest, but made me very cognizant of being on top of the yield sources that are underlying, is the transition from Morpho v1 to Morpho v2, which has happened much more rapidly than I expected, which really shows the power of incentives. As the Morpho protocol has incentivized Morpho v2 vaults, you've seen capital shift over to them quite rapidly. If you look at Morpho and V2 a few weeks ago, I think one of the most popular Morpho V2 markets was like maybe $1 million maximum. And if we look at V2 today, it's we have over 100 million in one of the markets, almost 90 million in one of the Gauntlet vaults, and over 90 million in one of the Gauntlet vaults. So it's moving rapidly, and we need to stay on top of that. So that is where the notion of updating new yield sources also came in. And that helps with the risk caps as well, because these new yield sources are higher yielding, and we can raise the risk caps and get much more exposure to these underlying yield sources. And so yeah, that's where the new yield sources also come into this proposal in the forum. So Morpho v2 is probably the highest priority one of all of them. It's the most expedient to do as well, as it's doesn't introduce any new collateral types, at least the ones that I mainly proposed. And of course, the code base is something that the protocol is very familiar with respect to Morpho. And then there are additional yield sources that I have proposed. For example, Neutral USD, Cap USD, and a few others that are emerging, and and that we want to get exposure to. So I've been a little bit long-winded, but in sum, it's really risk caps, and opening up risk caps are really about making the vaults more competitive relative to other options, and giving users broad-based access to underlying yield sources, whereas today I feel that they're too conservative. And expanding the underlying amount of yield sources within a specific vaults for specific assets is really about just staying on top of the market, and really staying on top of the underlying yield sources that are emerging, because at the end of the day, this is what it's about. It's about giving users automated access to the best and highest quality yield sources, which is what we need to do.
Thank you so much for this overview. I have maybe one sub-question here, and I was wondering, since you were quite in close communication with Block Analytica when it comes to setting the caps, what is your sort of proposed timeline for these proposals? So as you already said, like sort of the highest priority seems to be right now on this transition of Morpho v1 to v2 vaults, and then there are supplementary proposals to bring in different additional sort of arcs across different vaults and networks. So yeah, what sort of timeline do you have in mind, and how do you think would be best to progress towards some sort of finalization of these?
Yeah, so it's an interesting question. The in rank of priority, the number one thing is the risk caps, and they're also the least effort, so to speak, because it is really about looking at the risk model and understanding, the quality of collateral, the exposure to underlying collateral that these different vaults have. For example, that is really the main thing, as depositing into some of these underlying, but like some of these vaults give exposure to fairly exotic collateral, which is kind of not what you want from a risk perspective. But in any case, Block Analytica goes, slowly but surely. So I think the cadence really that people should expect is about probably 2 yield sources per week. Is what is the vibe that I get. 2 to 3 yield sources a week will have their caps gradually raised. Of course, if it makes sense. For example, it doesn't make sense to raise the caps on yield sources that have lower yields for whatever reason. So the criteria is, hey, the collateral exposure is good, and the yield is high-ish relative to the sort of the high level yield on the vault, and then the caps will be raised. And I think that the cadence around that is around 2 to 3 per week. So that's number one. Number two is the transition from Morpho V1 to V2. So that is the second thing. I think the timeline that we should expect there is at least to have that in the governance votes next week for the highest priority ones, which is great. I'm very pleased with that. And then after that, the Block Analytica is also very involved with the DAO-Managed vault, so you kind of have to think about that timeline in concert with this stuff as well. So I would say the DAO-Managed vault comes right after that, so that's around the 9th, or Chris said just the 16th of February, I believe. And then after that comes the newer yield sources that have been proposed. So those are the things like neutral USD, cap USD, things like that. So I think a good way to think about it is, lots of things happening every week for the next at least month. And those things are: 1, risk caps being raised every week; 2, the transition to Morpho V2; 3, DAO-Managed vaults; and 4, new yield sources that are, I'd say, net new yield sources, not just new versions of Morpho or new types of Morpho vaults, but new in terms of just completely different yield sources, neutral USD, cap USD, things like that.
Sounds good. Thank you so much for this overview. Again, if anybody has any questions, please raise your hand and come forward with them. Otherwise, I would suggest that. Oh yeah, I see you, Brian. Please go ahead.
Yes, mic check. Can you guys hear me?
Yes, I hear you well.
Nice. So my question was around, namely, I think I mentioned this on the forum, how we're gonna label or name the DAO-Managed vaults. So on something like vaults.fyi, we already have USDC lower risk, USDC higher risk. And obviously we're gonna want some visibility on the DAO-Managed vault. So I was just curious, how we're gonna sort of, position a third USDC offering. It's already low risk, high risk. How are you gonna label it in a way that attracts people but also doesn't scare them?
Yeah, that's a great question. I was thinking about that myself just a second ago, or a little while ago. I'm not so big of a fan of the term DAO-Managed. I thought originally about the term indexed. I'm not so sure about that either. One that I have seen around many different vaults, or protocols like Euler and Morpho and other ones as well, has been the word frontier. That has come to my mind. The word alpha as well has also come to my mind. So those are 2 that come to mind. Alpha and frontier. I think those are both somewhat self-explanatory. that can also be branded in a very nice way. That's my personal opinion, though.
I think Frontier was a little bit different on Euler, though, right? Like they were ones where any project could come to the forum and basically launch like almost self-curate from the project point of view, as opposed to being kind of like managed by the DAO in a way. And I'm also not sure if the Frontier ones on Euler got a bit of a bad rep after October, because I think a lot of those had issues, right?
Yeah, I would agree here with Chris also regarding the Frontier, but it is a great question. I think it's something that we should definitely explore further on the forum. It really feels like a clear distinction of these is going to be of an essence, right? Like we have to really make sure that the users of the Lazy Summer protocol understand it in like sort of as quickly as possible, that these are not sort of risk created by Block Analytica directly. So yeah, I think very good question, and definitely something that the delegates and the community should sort of coordinate around. Unless there are any other questions, I would move onto our next topic, and that's the Summer token. And also, please don't forget that there are loads of these proposals that also Jordan was mentioning are already posted on the forum, and it's quite of a high importance. So I'd like to just bring it to attention to all the delegates and the community members to voice your thoughts on the forum there. Now that the Summer token is transferable, I think the most important question is no longer how do we launch, but how do we use Summer to support protocol sustainability. And this is touching essentially two proposals that the DAO has been coordinating around in this past, let's say, a week or 2 weeks here. Maybe I would like to start with I see Thomas has joined the call as well from the Arcadia. So I want to touch on SIP 517 and 517.1 around the Summer liquidity balance. And yeah, if you are here, could you share how Arcadia is currently managing the position and what constraints we are working under, and why there was a need for this sub proposal, and essentially what is the status right now of the protocol owned liquidity deployed onto Arcadia?
Yeah, sure. So I would say now, after past two proposals, the state of the protocol owned liquidity is exactly as we laid out what that would happen. So the position is created, the liquidity is alive. It's a very broad range, spanning close to 200,000 ticks, meaning that the liquidity is quite thin, but it spans a very large range, and also big price shocks can still happen. So the price, the token can still find its price without, for instance, consuming the full amount of USDC of either SUMR. So I would say now the account is healthy. The IRO emissions that the liquidity receives are since yesterday directly streamed to the DAO wallet as well. So there's no periodic claim necessary. That directly goes from the liquidity position to the DAO account. Why was the second amendment necessary? I think as we laid out in the first SIP, we didn't know what the price of the token would be 24 hours after launch. So we started with an initial amount of Summer tokens, but 24 hours after the transferability event, when the liquidity should be created, the balance of USDC and Summer token was not sufficient to build a 50-50 position. So initially we worked with a quite asymmetric position since the amounts didn't match up. So we needed some extra Summer tokens. In the meanwhile, those are added to the account. So right now the liquidity position is as stated. Maybe as final remark, we still didn't decrease the range. I think in the proposal we laid out that we would do that after 1 to 2 weeks. We're now 1 week further. I think our advice would be to still not do that. I think yesterday when the initial emission stopped, we saw quite some big volatility spikes, quite some big buy and sell orders. So I think the, let's say, price discovery is still ongoing. It's a bit the ignition at play here, where you start bootstrapping with highly incentivized positions. Over time, you go more towards sustainable organic emissions. That's why the DAO has acquired the VE IRO stack. But yeah, I think now the mercenary liquidity has to be replaced by real liquidity, and only then we will find the stable, fair organic price, and then we will start decreasing the range width of the liquidity of protocol-owned liquidity position. Yes, yeah, Jordan.
Yes, you seem quite knowledgeable about the price action, obviously, and I think something that might be worth, well, I'll speak for myself first, and then maybe more broadly around the community, is when it comes to the price action, I think I wonder what myself as well, maybe not myself, but the broader community can do to maybe support the price action. I think that's a little bit of a black box. I guess the obvious thing is just buy, right? Like is the big thing. But just wondering from a more technical point of view, if there's one, like, is there a way that the broader community can support the price action in any way other than
so I think there are like two things to consider here. Like, one is how Aerodrome works. So basically it works with weekly epochs, and every epoch you vote for the amount of aero emissions of next week. So normally the amount of votes and the amount of rewards stay quite constant week over week. So there's not a big difference in the type of yield farmers you attract. I think here with Aero Ignition, that's a bit different. Here you have a lot more emissions the first week than the coming weeks, meaning that the first week, many of the liquidity providers, to be very blunt, they didn't really care that it was Summer token. Like, they just tried to farm yield because it was a high yielding pool. The result is that they didn't want to hold Summer tokens in their inventory necessarily. So now that the first epoch has passed a few hours ago, some of them unloaded their liquidity positions, meaning that the part of Summer in their position, that they had to sell them on the open market, which is the pool itself. So that quite some shocks. On the other hand, we saw another user like building up a position now. So I think that user kind of knew how Aero worked, kind of suspected that a dump would happen today, and he put orders on the other side. So I think if you don't know the details of Aerodrome, I would not try to play these games with timing buys and sells. I think if you want to support price, best thing you can do is add some liquidity, but not with the goal of optimizing your yield. So do it quite broadly. You will not get these crazy yield percentages. I mean, they're still nice. Like with the Aero position we have with the protocol-owned liquidity, that's super broad, and it still has a decent return even post the initial emissions. So as a community member, I would say you want to support the price, you don't have to, but if you want to, best you can do is make a fairly broad liquidity position in the pool, and then you help catch these kind of shocks. Do know that you have to put in USDC and Summer. So if there's a big shock up, you will sell some of your Summer for USDC. If there's a big shock down, you will sell some USDC for Summer. So if you know what you're doing and you're willing to support price, that's a good option. If not, then I would say I'll let the market play out. What we do is we support liquidity, right? We don't support prices. So with protocol-owned liquidity, the goal is not to manipulate prices. Like if the overall market decides that the price has to drop, there's nothing we can do against it. We just see that the liquidity position at all remains healthy, whatever the price is. So I think if you want to do that as a member, the best way to do that is with kind of broad liquidity positions, or what you also can do is set up the similar things as limit orders. So you can build liquidity position below current price. So if price moves down, that you buy more summer at lower prices, if you're willing to do that. But maybe I'm going a bit too technical here for the community call. But if you have more questions, feel free to ask them in private to me, or ask some questions on paper, and I can write out the answers.
Yeah, I definitely will follow up. I think one other thing that to tack on with from more maybe of a community perspective is, as we've seen, there's people in the Lazy Summer community who have at least, if not a couple of degrees of separation, maybe only 1 degree of separation to funds and whales and things like that. So I think if we have a very comprehensive way of supporting both liquidity and price, as you talk about, it should be easy to send that to people who can maybe support, who can provide additional support, just like the protocol is. So yeah, we'd definitely love to hear in more detail afterwards.
Yeah, sure. We can do that synchronous after the call for sure.
Maybe one thing to mention here also in terms of the arrow. So as you pointed out, the previous voting epoch has ended, and now there is a new epoch on Aerodrome which ends in 6 days. And I'm just looking at some of the metrics here on Aerodrome, and it seems like the summer USDC pool has already attracted 2.3% of votes. And yeah, keep in mind that this has just started. So there's around 22, above 22 million VARO votes already allocated. And now we can also finally see that. So one thing again to point out here is that during the first epoch of ignition, there has been 3% of the summer token supply allocated, whereas under the second epoch, there is still additional incentives, which I believe were at 0.3%. So there are more summer tokens coming into the pool. Also we have seen this sort of liquidity shock, let's say, bringing the TVL down, but is still around above $300,000 at the moment. But what we can see right now is the fees that has been generated on this pool. At the moment, these fees are around $68,000, which I think is no small feat here. And with the VAPR at the moment moving around 37%. I think, thank you so much, Thomas, for coming in and telling us more about the Arcadia and the status of the proposal and how we manage this sort of protocol-owned liquidity at the moment. I think something to point out again, and I believe you have mentioned it, but just to repeat on that, is that now the multisig that was assigned to sort of forward that liquidity to the Arcadia account has pointed the rewards directly to the DAO treasury, whereas before it was still pointed towards the multisig. So I'm gonna make an update also on my own end onto the forum with the transfer amount of the VARO tokens earned, which I believe is around 500 or something like that, so that will go to the DAO treasury so we can accrue those rewards. And then maybe it could be also an interesting idea to either make a proposal to point those Aero tokens directly again to the multisig that has been created in terms of Aerodrome meta governance, which is the next topic that I wanted to touch upon. I believe Brian, I'm not sure if Mojo has joined us, but Brian is here, and maybe I wanted to ask you to talk a little bit about SIP 518 and the status of the Aerodrome meta governance. this proposal aims to really reduce the long-term incentive spend. It also aims to compound the Arrow votes via flight school, and then potentially we can connect it with the Arcadia farmed Arrow tokens, and therefore create a sustainable liquidity flywheel for Summer on Base. So if you are here, Brian, could you jump in and tell us a bit more about the proposal that has passed through 518?
Yeah, definitely. The Arrow meta governance proposal passed. We got the initial proposal issued around, I think it was 12,000 USDC in total to our multi-sig. So we received that after the proposal was executed. We're still awaiting some more funds from the foundation multi-sig, which we should receive this week. So far we've made our first purchase of Arrow. We managed to buy some discounted V-Arrow NFTs, and we managed to vote literally just a few hours, minutes before the end of the epoch that ended yesterday. So we are already voting, we're already participating in the V-Arrow meta governance. We're doing our best we can to support the Summer USDC pool. As Jensei mentioned, obviously the fees generated so far are pretty good, and we hope to, keep that liquidity pool more attractive to liquidity providers. And we should be also earning flight school rewards, even though Aerodrome will be discontinuing that program sometime in April. We should be earning some flight school rewards for the next 2 or 3, 4 months. And we can look at how we can further continue to incentivize liquidity or boost the Summer price using those rewards. But and obviously the flight school rewards will be moving towards an ecosystem fund to basically, improve the economics of the Aerodrome ecosystem. So still looking out for sort of the second order effects that will have on, on like liquidity pools like ours and the VR position like ours. And we'll continue staying up to date and updating the community on anything that needs, action, or, any plans we'll come up with to further incentivize people to provide liquidity and or support the Summer price.
That's great. Thank you so much. I would like to mention, of course, I think it would be of a great importance to sort of create a transparency report under the SIP in the forum, sort of after these transactions of the multi-sig has been executed, and creating links to those and explaining what has been done and what is the status right now. So I think that would be lovely to see on the forum as well for the wider community to follow this process. I was actually just checking on this V-Arrow Lazy Summer DAO multi-sig that has been created, and I believe at the moment the Arbitrum is already holding 11,790 USDC. It's holding 11,410 USDT 0. So this is on Arbitrum. And on Ethereum mainnet, there is 10,000 USDT, 11,710 USDS, and 8 wrapped ethers. So these tokens are meant to be, I believe, bridged again to Base and swapped for USDC and then for Arrow to make the V-Arrow purchase, and then sort of within this next epoch, which is for next 6 days, to cast votes onto the pool. So I believe these are the next scheduled transactions over there. And I believe, again, as these transactions are going to be executed, I think it would be great to make a community update on the forum about these moves. Thank you again so much, Brian, for hopping in and telling us more about the moves of the V-Arrow. And maybe I'm not sure if there are any questions regarding the V-Arrow meta governance here. If there are, please again raise your hands. Otherwise, come into the forum and let's continue the discussion here. I guess. Of course, if there are any general questions, do that as well right now. I think now we have a couple of minutes to explore any sort of governance related questions or any questions that are connected to what we have discussed so far. Otherwise, we can maybe finish this call. I would have a couple of closing thoughts here. I really want to highlight that we are sort of moving from this launch decisions of the transferability of the Summer token towards more structural decisions, and I love to see that. I believe also slowly going from the reactive governance to more intentional governance. I think we can see that with the newly proposed sort of arcs and really getting a foot sort of into the right direction, stepping into the right direction towards getting those higher yields also onboarded onto the protocol. These DAO-managed votes and the risk caps, and I think the summer strategy, they are all sort of expressions of the same underlying question here, right? Like, can we sort of scale without losing discipline? I think this is really important because one thing is to scale, another thing is to scale sustainably, and that's what I would like to highlight on this call as well. As we are getting, the frameworks right, the individual votes get, I believe, easier as well. So I'd like to thanks to everyone who contributed today, especially also, of course, those who have been active on the forum. And of course, again, I would like to call you all to jump in on the forum, review what's being proposed to the DAO, and see how we can move forward. Yeah, please keep the discussions going there. That's really where the ideas become binding. I saw Catherine was raising her hand. If you have anything you want to step in with, please feel free. We still have a couple of minutes.
Oh, hi. Sorry, I was going to ask if we will be discussing the new delegate framework on this call as well.
Yeah, that's a great question. Actually, it wasn't on the agenda for this call, but I believe it's quite of a high importance, and thank you so much for bringing it into attention again. I would say that the sort of on the forum, it seemed like yes, we should definitely make the next steps for the new framework for the delegate rewards, and I think we should continue the discussion on the forum. If you have something that you would like to share with us or some of the thoughts since last call, please feel free to do so.
Okay. Maybe I can ask for just maybe a couple of minutes, maybe some 3 to 5 minutes. I actually wanted to share to everyone. Recently, Curialab finished analyzing the 2025 delegate rewards data, and we actually found some important trends regarding how we spend the Summer token. So we've posted the full research on the forum, but the headline that we currently have is there's a misalignment between treasury spend and governance activity. So there are actually 3 points that I want to highlight. So the first point is So the first point that I want to highlight is that in May we actually had a high workload of 14 proposals, but the payout was only 126K summer. While in June we only had one proposal, but the payout was 152K summer. And with this, June was the second highest monthly payout of that year for a single decision. So this confirms that under the system, treasury spend does not scale with the amount of governance work being done, and that the quiet months are effectively being paid at a premium while the busy months are discounted. And the second point is that we observed that there was a activity paradox. Originally, it was designed as a quantitative incentive to reward delegates who go beyond simple voting and actively contribute to governance discourse. But in practice, the 100% participation has since become the default path. With in June, there was minimal work required, which meant that 100% of the delegates qualified for the boost. While in October, where there was 14, where there was when was this, where there was a higher governance demand, the qualification dropped to 52% only. And currently, the boost is triggered by attendance alone during quiet periods rather than meaningful discourse it was designed to reward. Uh, and on decentralization, while growing 14 delegates while growing from 14 delegates in March to 23 in December was positive, it it was established this establishes a higher fixed cost baseline for us, which meant that our base pay obligations are scaling linearly with headcount, regardless of whether the governance activity remains flat. So taken all of this taken together, this points for a need for realignment. So we propose two paths for the community's feedback. So path A would be a dynamic pay, where we move towards a more responsive model, where it would be like a rubber band, where when the retainer where the retainer scales with the workload. So there would be low standard and high tiers. So in the lower activity months, it would cost us less, while on the higher activity months, we would be compensated more appropriately. The second path would be raising the bar, where we transition the boost from a quantitative threshold to qualitative filters like the peer recognition score that we mentioned in the last community call. This would ensure that we are rewarding high signal contributions rather than just volume. Uh, so with this, we'd love to know what the community thinks, how we should move forward, whether it would be through a dynamic base pay or to manage treasury, or a restructuring of the boost to prioritize quality over participation. So the full data is up on the forum, and we would love to get some feedback on that.
That's great. Thank you. Thank you for sharing this. Yeah, I think it's really interesting again to continue exploring this topic as it's quite of a high importance going into this like sort of next phase for the DAO. I'm really curious. Do you think sort of the score that you guys have created, could it be used, for example, specifically for the boost rewards, or do you imagine this should be used as a baseline for any delegates and any sort of rewards distribution there?
For me, I think it actually depends on what the DAO is ready. How much restructuring are we actually willing to do? Because for the PRS, I think that for the peer recognition score, I think that to test it out, it would be good to have it at the activity boost. But if we're gonna have more talks regarding what do you call it? If we're gonna have more talks regarding using the delegate score or the peer recognition score as a baseline, I think that we have also opened the topic regarding that we can customize the score regarding to how Summer would like it, which criteria Summer would like to count as important. Yeah.
All right. I think this is interesting, and I think definitely there could be ways how to sort of prototype it first with the
Mhm.
with the boost, with the activity boost, and then sort of looking forward to sort of exploring it to a wider integration. Yeah, I would definitely love to see more delegates sort of chiming into this topic, and potentially we could create a working group that's focused across for the sort of, let's say, maybe across the month of February to exploring what this framework could look like, and then bringing it up to an on-chain vote to sort of solidify this going forward. And I believe it would be, of course, great if you guys would be up to sort of lead those discussions as well. And I'm of course happy to help structure it as well and coordinate around the working group. How does that sound to you?
That sounds great. Definitely would love to give our input and lead the discussions on this. Hopefully, we get enough feedback so that the system works as how we want it and we can build it together.
That's great. All right.
Mhm.
All right. I think this is awesome. Again, thank you so much for coming in and bringing this important topic to the light.
Mhm.
Yeah, I want to make sure that I'm not keeping back any of you guys that needs to be other places. So again, thanks everyone who contributed today, and yeah, let's keep the discussion going on the forum, and see you on the next call again soon. Thank you so much, everyone.
Okay, thank you so much.